Hey everybody, welcome back to the channel. This is Jeremy Cable, and today we're going to be talking about trend trading and how it applies to the current bear market in technology stocks. So first of all, just want to start off this video with a subtle plug to myself. You know, I do have this book called Follow the Money, Trade the Trend, and we are currently in a pre-sale of this book. So if you'd like to get on that pre-sale list, all I need from you is pretty simple. I just need your name and your email, and then just click join the trend down here, and you'll be into the pre-sale list. I'd really appreciate it if you could help me out. And if you're looking for somewhere to go to find this, just go to followthemoneyttt.com. I'll make sure to put this link down in the description. And while you're at that site, make sure to check out the blog. That's kind of where I post, you know, the write-up for all of these videos that I make. So take some time to do that. I'd greatly appreciate it. So let's get right on to the video. So what we're going to talk about today is the simplest thing to identify trends, and that is trend lines. So here's a little bit about trends. Trend following is nothing more than interpreting what is. There's no guessing or predicting what's involved. You simply look at the market structure to determine if an asset is in an uptrend or a downtrend. Trend trading is an essential component of the technical analysis approach. So Investopedia defines trend trading as follows. Trend trading is a trading style that attempts to capture gains through the analysis of an asset's momentum in a particular direction. When price is moving in one direction overall, such as up or down, that is called a trend. So while there are millions of ways to identify the trend of an asset, ranging from the simplest to the more esoteric, we're going to use one of the oldest and easiest trend indicators around, the trend line. So if you're new to technical analysis, if you're new to chart reading, let's just take a look at this. So trend lines have been common in mathematics since statistics became a widely studied school of thought. It then makes sense why trend lines found their way into the stock market, as many of the pioneers of technical analysis got their start in mathematics. With this basic knowledge of trend lines, let's discuss how they can identify market structure. And market structure categorizes if an asset is bullish or bearish. Bullish means that the asset is in an uptrend, and bearish means the asset is in a downtrend. Market structure is a very large term. You kind of hear it thrown around willy-nilly if you're reading articles or watching any news programs. So let's kind of define what market structure is a little bit more. Market structure, also referred to as the trend, makes you look at the asset's price action over a period of time. A single day of price action is not enough to determine the trend, but it can indicate when the trend has changed. In order for there to be a trend, you need a combination of days all moving in the same direction. Higher lows, higher highs, lower highs, and consolidation are different market structures that can be observed in the price action of an asset. And as a trader, it's your job to really determine when the trend has changed. That's how you're going to make all of your money as a trader, is looking for changes in trend and positioning yourself to make money off that new trend. So like I said, you know, I gave a plug to my book, so now we're gonna kind of use an excerpt from that book, and I'm going to go over the section of where I kind of explain to everybody how to use trend lines to define market structure. So what we're looking at right now is a chart of crude oil prices. This is the futures contracts. So what we're seeing in this chart is a pattern of higher lows. Higher lows is a bullish to neutral market structure. Higher lows are a charting phenomenon that occur when price puts in a bottom and runs up, but it doesn't necessarily make a higher high. From there, price will throw back to the trend line and stop at a price that is higher than the most recent low. Higher lows without higher highs is a potential accumulation pattern. What this means is traders are stepping in to buy the low points of an asset, but there's not enough conviction to push the asset to higher highs. This is kind of a unique example where we are seeing higher highs and higher lows, but I do want to kind of emphasize on the higher lows within this. So down here, you know, pretty easy thing to do. You just look for, you know, the lowest lows within a current uptrend, and then that's going to be your starting point. And then you kind of just draw an arbitrary line to connect to other low points within that uptrend, and this is how you define your higher lows. Moving on to higher highs. Higher highs are also a bullish market structure. Higher highs tell you that an asset has that upward momentum, and this is evident because price is making new highs. You know, the most important thing to do if you're trading the upside is to have price making higher highs than it was previously, and that's how you're going to make your money. The asset wants to keep going higher until it doesn't. To make higher highs, an asset must pull back, stop, and then overtake the previous swing high. Most often you will see higher lows before higher highs, but not always. Looking at this chart of Apple, you can see we made a high here back in April of 21, and then we made our second high in July of 21, and then we made our final high here in September of 21. And this is a clear pattern of higher highs. This is what you want to see when you're trading to the upside. This is how you know you are going to get that upward price momentum. Moving on to our next market structure definition, we have lower lows. So lower lows are bearish market structure. Bulls are no longer stepping in to buy support. So if bulls were buying support, you wouldn't see a pattern of lower lows. You would either see a sideways consolidation or you would be seeing those higher lows. So this tells you when you're seeing lower lows that sellers are now in control, pushing prices lower. Any moves in the market are considered dead cat bounces that entice bullish traders into buying just to have price pushed down lower. So looking at silver back in June of 21, we see our first low here, and then we get another low here, and then we get another low down here. So you can see that bears are clearly in control. No one is stepping in to buy these support levels. You had a support here around the 25.5, then you had another support around 24.75. We had another support around 23, and then we found our final support around 21.5. So this is just a continuous downtrend, and that's not what you want to see when you're trading to the upside. And then next up we have lower highs. Lower highs again are bearish market structure. Price can no longer make new relative highs, and this clearly defines that bears are in control. And this is pretty evident when we look at a chart of Verizon back from 21 to the end of 21. Just a clear downtrend. This is a very simple trend line to draw, and you can see that there was no upward momentum because price just couldn't simply clear this simple line. And that's all that trend trading really comes down to if you're using these trend lines is can price get over the lines that you've drawn, or can it go below them? And that's how you're going to be able to define your trend. So now moving kind of into today's market structure, let's take a look at some charts. So the NASDAQ 100 is the benchmark index for all technology and growth stocks. Beginning in the later part of 21, the Q's market structure shifted from bullish to bearish as it experienced its first lower high near the end of March 22. So January 22, we got our highest high, and then here in March 22, we do see a lower high. So this is when you kind of start drawing your trend line, and you can see that the bears are clearly in control because this trend line has not been violated until recently. So with the Q making confirmed new highs this week, I'd say it's safe to say that the technology bear market may be over. This observation is confirmed by the simple fact that the Qs are bucking current market structure and the downtrend line has been violated. So with the Qs, the technology growth stock benchmark entering a new trend, how do the stocks that make up the Qs compare to that? Let's go look at a chart of NVIDIA. NVIDIA's chart should look almost identical to the chart of the Qs. NVIDIA made a pattern of lower highs in 21 and recently broke that downtrend. So in 21, here is your highest high. Then in March of 22, we get a lower high, and then that continued to dominate up until recently. NVIDIA had an uptrend, higher lows within a downtrend, lower highs. This leads us to an important concept. An asset can experience a bullish trend within an overall bearish trend, and vice versa. Within all assets, there will be trends that characterize the asset's performance over the last few years. There will be trends that characterize the asset's performance over the last few months, and trends that characterize the asset's performance over the last few weeks. Within technical analysis, there's this fractal nature, and identifying trends within trends only magnifies this fractal truth. Next up, let's take a look at the chart of AMD Advanced Micro Devices. Since AMD and NVIDIA are within the same industry group, the semiconductors group, it makes complete sense that they have almost identical chart patterns. So AMD saw multiple lower highs in 22 and recently broke that downtrend. AMD also made higher low in early 23, and it's been riding that uptrend since. So here's your pattern of lower highs. Same thing we've been seeing in the Qs and NVIDIA. And then here are your higher lows that brought us to our most recent breakout. Same thing as NVIDIA as well. Next up, let's take a look at Adobe. So same thing as the Qs, lower highs, and then we get a breakout to new highs. So Adobe's downside has been much more consistent than the Qs or the semiconductors that we looked at before. You really didn't get that many tests of this trend line, and that's something that you're going to see when the market is extremely bearish. Bulls can't even bring it up to make a new lower high consistently, so that just lets you know that the bears are definitely in control when we get these deep, steep down moves. And those are three stocks that we saw that have broken out, and they're following the trend of the Qs. But now let's take a look at some stocks that have yet to break out from their downtrends. So Palantir, that's another one. Sorry, I forgot one more. So like most growth stocks, Palantir's price was down over 60% in 2022. This is a massive downtrend, and shareholders suffered if they continue to hold. So this is why it's imperative to notice these changes in market structure and exit stocks that are now in bearish downtrends. I'm going to repeat that. So this is why it's imperative to notice changes in market structure, and you need to exit stocks that are now in bearish downtrends. Please, please, please take note of that and start implementing that in your trading strategies. So moving on to our kind of laggers. These are stocks that have yet to break their downtrends and are looking for potential breakouts. So that's Airbnb, that's Microsoft, and that's Roblox. Like I said, these stocks are kind of lagging behind the rest of the market, and they've yet to break out. So if you're looking to kind of buy some of these stocks that are behind the rest of the pack, these may be three potential targets to take a look at. So that's kind of a brief introduction on trend lines, a brief introduction on market structure, and it left you with some actionable ideas to maybe implement into your trading strategies. Again, if you have any questions, feel free to drop me a comment or send me an email. Make sure to like and subscribe, and thanks for watching.